There is no doubt that mutual funds are one of the best investment options to create wealth. But the problem is that majority of retail investors don't know how to build a right mutual fund portfolio. In fact, there was a research that mentioned during 2003 to 22, retail investors' returns were very low as compared to mutual fund house returns. And that too, when the market has generated multifold returns. Now think about it. If markets have generated multifold returns in last 20 years, then mutual fund investors should also make good money, isn't it? Then why retail investors' returns were very low? The reason is multiple mistakes that retail investors make while investing in mutual funds. Hey everyone, my name is Sahil and this is my Personal Finance Academy. Over the last few years, mutual funds have started to gain popularity in India and many young investors have started their investment journey with mutual funds. But the problem is that today there are thousands of mutual funds available in the market and majority of retail investors don't know how to build a right mutual fund portfolio. Moreover, people end up making multiple mistakes in their investment journey. As a result, they struggle to generate good returns. The report that I mentioned earlier clearly called out that one of the biggest reasons why retail investors' returns underperformed is due to high churning of their portfolio. It means investors keep buying and selling mutual funds. This is just one of the mistakes. In fact, personally, I made a lot of mistakes during the initial couple of years of my mutual fund investment journey. So I thought of creating this video on 5 key mistakes that I made in my mutual fund journey during the initial days and my learnings from it. Then another common question I get is, Sahil suggests us top mutual funds to invest our money. So I have answered this question at the end of this video. Hopefully, it will help you in your mutual fund journey. Alright, let's get started. So my first mistake was investment based on past return. During the early days, my thought process to identify mutual fund for investment was pretty simple. I would sort the mutual fund by their past performance in the last 1 to 3 years and shortlist mutual funds with the highest return and invest my money. I thought if the mutual funds had outperformed in the past, they would continue to do so in the future. But next year I realized that the funds where I have invested earlier are not generating the highest returns. In fact, some of them were among the worst performing funds. That was a shocker for me. I was completely blank about what to do. For the initial couple of years, I kept on switching my funds by selling the underperformer and investing in the top performer. Basically, I was chasing returns. Later, I realized that it was a big mistake to simply invest based on past return. Because every year, there are different winners in mutual fund industry. There is no guarantee that a top performing fund today would continue to outperform next year. In fact, many mutual fund investors still make this mistake of investing based on past return. And that's where it's very important to look at multiple factors to shortlist a mutual fund like your AUM, expense ratio, fund management, investment style, along with your past return, and then build a balanced portfolio as per your financial goals and risk appetite. In case you're not sure if your mutual fund portfolio is rightly balanced as per your risk appetite and goals, there's a free app called Deserve Wealth Monitor that provides view on which fund to hold or exit in your portfolio. They have a team of experts that would review your portfolio for free and provide their views in terms of which mutual fund you can hold and which you should exit. This exercise would help you identify the underperformers and replace them with the appropriate fund. They also suggest funds for investment. My second mistake was irregular investment. During my initial investment journey, I wasn't very serious about it. I was very irregular with my investment. Now, whenever we invest in mutual funds, it asks whether we want to invest in lump sum mode or SIP mode. So I thought rather than doing the SIP, let me invest in lump sum mode where my idea was to time the market and invest whenever there's a correction. But then, whenever there were corrections, I would wait for more correction. Sometimes I would simply spend the money and would not have the money to invest at the time of correction. Basically, I lacked discipline with my mutual fund investment during my initial days. Actually, one of the major reasons for this indiscipline was lack of proper planning. When I started my investment journey, I did not list down my financial goals. My only goal was to create wealth. But due to this lack of financial planning, I missed a sense of discipline. Another problem was that I would panic on correction and would simply sell my mutual funds. I never understood the risk part of equity investment. Later, I realized my mistake and the importance of long-term investment in mutual funds and started SIP that enforced discipline in my investment journey without trying to time the market. My third mistake was no index funds in portfolio. During those days, my goal was to invest in active mutual funds that can beat the benchmark by a high margin. To be really honest, I found index fund very boring. For instance, a Nifty 50 index fund would simply invest in 50 companies of Nifty in the same allocation as per the weightage of the stock in the index, and the returns would be again average. So there was no thrill. Basically, I found index funds boring. The actual thrill was in investing in active mutual fund that can potentially beat the market. Again, it was a big mistake, because later I realized that a lot of active mutual fund in my portfolio are not even able to beat the benchmark. Forget about generating high returns. They are not even able to generate returns like Nifty 50. In fact, there was a latest research that mentioned that around 68% of actively managed funds failed to beat the benchmark in 2022. Only one-third of active funds were able to beat the benchmark. The same report mentioned that over a period of last 10 years, around 60% of large cap mutual funds were not able to beat the benchmark, and around 50% mutual fund in mid and small cap category failed to beat the benchmark. And every time the active fund would underperform, it gets very confusing about whether to continue investing in that fund or sell it. And that's when I realized the importance of low cost index funds that might not beat some of the active fund but would not be among the bottom performing funds. So that decision to invest in index fund really gave me peaceful sleep. And now I always say that your mutual fund portfolio should have a fine balance of active and passive mutual funds. Today, more than 50% of my mutual fund portfolio is in Nifty 50 index fund. So you got to have passive funds, that is index funds in your portfolio. My fourth mistake was lack of diversification. Since my major focus was on identifying mutual fund with high return, I ended up having high exposure in your mid cap and small cap mutual fund. I even ended up investing in some sectoral and thematic funds that were outperforming during that time. I hardly had any allocation in large cap category, and that resulted in my portfolio being highly skewed towards the high risk category. Later I realized this mistake and then rebalanced my portfolio by removing the high risk thematic and sectoral mutual fund and evenly distributed my money across large, mid and small cap category. And the most important aspect is to understand the financial goal and risk appetite so that you can build a well-diversified portfolio as per your risk appetite. My fifth mistake was investment in too many funds. So during the early days of my mutual fund journey, I had no idea where to invest my money. There were many categories in equity mutual fund like your large, mid, small, then focus fund, multi-cap fund, tech saving fund, then you had sectoral and thematic funds. And within each of those categories, there were a list of mutual fund offerings from various fund houses. It was very confusing to pick the right funds. So I would randomly Google best mutual fund to invest now and would get multiple blogs. So that time YouTube videos were not popular. So I would go through those blogs and would randomly pick mutual funds with great return in the past. Then I would discuss with my friends and colleagues and again invest where they have invested. Another problem, like I mentioned before, since my investment was mainly based on past return, if a mutual fund did not perform well for 6 months, I would stop investing in it. And again, identify the best mutual fund in terms of returns and invest in that fund. So in this process, I ended up with nearly 10-12 mutual funds in my portfolio during the early days. It was a complete jungle. The biggest confusion was which mutual fund should I continue and which I should sell. It really took me a while to figure out the right 3-4 mutual funds for my long-term investment journey. That include a Nifty 50 based index fund, couple of flexi cap fund and one emerging blue chip fund. So if I quickly summarize my mistake, first was investment based on past return, second was irregular investment, third was no index fund in portfolio, fourth was lack of diversification, and fifth was investment in too many funds. Among these, which mistake have you done in your portfolio? Let me know in the comments. Now the most common question I get is, which is the best mutual fund to invest money? Honestly speaking, there is no best mutual fund. Everything boils down to your individual goals and risk appetite. What is best for me might not be best for you. And like I said before, you can't just shortlist mutual funds simply based on past 1 to 3 years of return. So the right approach to build a mutual fund portfolio is to first identify your financial goal and risk appetite and accordingly build a diversified portfolio of mutual funds. It's also very important to rebalance your portfolio. So let's say you started investing with a long-term financial goal of buying a house in the next 10 years and your major exposure was in equity. But now you have completed 8 years and want to buy the house in the next 2 years. Obviously, now you want to reduce your equity exposure and increase exposure in debt mutual fund or hybrid mutual fund. Hence, a regular mutual fund review and portfolio rebalancing is very, very important. That's where I mentioned earlier that you can get your mutual fund portfolio reviewed for free using Deserve Wealth Monitor app. Once you download the app, you have to put in your PAN card and phone number and verify it with your OTP. And then you can see your mutual fund portfolio and detailed analysis of your fund. These insights can help you rebalance your portfolio in a timely manner and aim to improve the return based on your risk profile and financial goal. You can even set up a free call with Deserve's expert to deep dive into your portfolio. So do check out this app and get your portfolio reviewed for free. I provided the link in the description box and pinned comment. So this is it for this video. I hope you'll find it useful. I'll see you next video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.